Assume Riley Pets Incorporated, or RPI, is a division of Rocky Animal Works, or RAW. RAW uses an ROI as the primary measure of managerial performance. Now, Rocky Animal Works has a desired return on investment, or ROI, of 5.8%. The company has $220,000 of investment funds to be assigned to its divisions. The president of RPI is aware of an investment that could use those funds. Now, not only can he use those funds, but he knows that the funds are expected to yield an ROI of 6.2%. And the financial statements you see are the division Rocky Animal Works financial statements. Okay, now they're presented in thousands of dollars, but perhaps it makes more sense to think of these as if they were as if all the numbers were presented in thousands. So the 720,000 that you see for sales revenue right here would actually be 720 million. Then I think this problem becomes more reasonable. So now we're talking about a $220 million investment. Okay. All right, but we'll just assume they're whole dollars rather than thousands as we work through this. Let me slide a little bit. Okay, the first question we want to tackle is, what's the return on investment of Riley Pets Incorporated? That's the division now, right? So what do? We know that operating income is $74,650. That's net income, but since there's no tax amount, net income is the same as operating income, right? We don't have there's no income before tax or income after tax. So net income becomes the same as operating income. So we've got operating income of $74,650. That's given to us. And the investment is the total assets, right? So the total assets come to $108,460. So if we were to calculate return on investment, we simply divide the $74,650 by the $108,460. Okay, now I'm showing it to two decimal places. It probably goes on to much more detail. That's not an exact number. Okay, so that's the return on investment. But what if we wanted to calculate residual income? We've got a bit more calculations to do. All right, let me slide on up here a little bit and give you a little bit more room to watch this. Okay, since the new project has an ROI that is, first off, let's figure out, would the president be inclined to accept this return? And the answer is no. And that's because his current ROI was higher than 688, right? What was his current ROI was 6 point, let me say this another way. We've calculated that his current ROI is 6.88. The new opportunity is 6.2. So the president would not be all that excited about this project. That's one of the problems with using return on investment. Because even though there's a positive return and it's higher than what the corporation wants, it would dilute his division's overall return. Okay, so he's probably not very motivated to take on this project. It'll lower his division's overall return on investment. All right, now, what would the residual income be if it was taken on? Well, the operating assets of the new project are $220,000. That was given above. And the expected ROI of this project was 6.2, right? We know that because the 6.2 was lower than the 6.88, and above the screen, the 6.2 was provided to us. I'll slide up and show you that again. Right there, 6.2. Okay, so let me slide back down. Now, what that means is if we take the operating assets and we multiply it times the expected return on investment, we're able to calculate what the expected project operating income would be. Okay, so the incremental income or operating income from this new potential use of $220,000 would be $13,640. That's part of the calculation. With residual income, we then need to subtract out what I call the minimum required rate of return. Different textbooks can call it different things. But you would take the operating assets, $220,000, and you would multiply that times the desired corporate return on investment. I'll slide back up again. Remember that the corporation, the corporation is Rocky Animal Works, and they have a desired return on investment of 5.8. So I consider that to be the minimum rate of return for a project to be approved at the corporate level. So that minimum level or required rate of return would be 220,000 times 5.8. Okay, that's 12,760. So now if we take the difference, we're able to calculate the residual income. Okay, and residual income is 880, which is just the 13,640 that this project is expected to return in terms of ROI, and compare that to the ROI, or the minimal level, the required rate of return, you can call it what you like, that the corporate wants. Okay, so now should they? Does it make sense to take this project on? Yes, it will increase the wealth of the organization by $880. Now, again, with whole dollars, I'd be inclined to say, well, that's close to break even. We're really going to chase this down for less than $1,000. It would increase the wealth of the corporation, but maybe there's a lot of risk involved in taking on this kind of project just to make $880. However, if we think all of these numbers are in thousands of dollars, then that 880 becomes $880,000. Again, now it becomes more meaningful. Okay, so that's just a brief walkthrough of how we work with residual income.